policymakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. China's outlook shows no sign of improvement as economists trim their growth expectations while traders await a raft of data over the next few days. Now, the UK's food inflation actually cools to its lowest level in almost a year, relieving some of the pressure on the Bank of England to keep raising rates. Plus, Bloomberg also learns who the buyer is for Goldman Sachs' investment advisory business as the bank refocuses its attention on the ultra-wealthy. So first thing is first, let's check on what traders are looking at. Now, this is the European markets map. I would suggest after the bank holiday, certainly in the UK yesterday, that we're seeing maybe, if not subdued action, maybe not the excitement of the last couple of weeks, but look out for any move when we have quite a lot of data coming out later this week. We not only have PMIs out of China, we have CPI in Europe, and of course, the big one is U.S. jobs. So for the moment, we're seeing the FTSE gaining some 1.2%, the DAX 0.1% higher, and then you can see, for example, the CAC 40 pretty much unchanged. Now, the focus is, of course, still on Jackson Hole, on what we heard from Jay Powell, and therefore we look at what the U.S. two-year is telling us, hawkishness more or less holding following this Jackson Hole speech where we heard from Jay Powell, the Federal Reserve Chairman, really saying in a highly anticipated speech that the U.S. Central Bank is prepared to raise interest rates further if needed, and that borrowing costs will likely remain elevated. You can see that two-year currently at 4.9896. We watch for 5. Yen, of course, this is on the back of what we heard from Jackson Hole, and this is an interesting Goldman Sachs call, basically saying that it's going to hit yen, the country with a very dovish central bank. We'll see further currency weakness with, possibly seeing yen at 155. That would make it the weakest since the early 1990s. You can see at the moment 146.45. And then the third story that we really want to focus in on is what's happening in China. We have full analysis from our team on the ground and here in London. The Hang Seng having a couple of really quite strange days. So we saw a sell-off on Friday. We also saw a bit of a sell-off yesterday, and today we're rebounding a little bit strong. Difficult to call bottom as we see and expect, actually, traders are expecting PBOC and other policymakers to try and support the Chinese economies in other ways. But if you look at all the major banks, a lot of them have actually taken out their position on Chinese stocks. Now, China's economic outlook is showing no signs of improvement. A Bloomberg survey shows that economists now see China's GDP growing 5.1% this year compared to 5.2% previously, weighed by the property sector and slowing exports. Now, speaking of the property sector, Country Garden seeking a 40 calendar day extension for its maturing yuan bonds. Now, the shares gained off the back of that news. Well, more on China's economic troubles shortly with JP Morgan's Karen Ward. But first, let's also go to Bloomberg China executive editor John Liu in Beijing for the latest on the geopolitical front. So, John, great to speak to you. The U.S. Commerce Secretary Gina Raimondo is in Beijing this week. Who's she met with, and what exactly has been discussed?
Well, this afternoon, she's just met with Chinese Premier Li Qiang. He's the second highest ranking official here in Beijing. We don't know the specifics of what happened behind closed doors, but we do know that Secretary Raimondo here has been trying to pitch the story that decoupling and de-risking are two separate things. That means there's a lot of trade that China and the U.S. do that has nothing to do with national security, and that should continue unaffected. But things like chips, other technologies that do affect national security, Washington will take things to protect itself in those circumstances.
So, John, China has also confirmed that UK Foreign Secretary James Cleverly is also visiting tomorrow. What can we expect between the UK and China?
So we understand that Secretary Cleverly will want to discuss Ukraine and Russia and China's role in that situation. What will China want to discuss? We did just have recently a newspaper here in China, the Global Times, a relatively nationalistic-leaning paper, calling for the British Museum to return all Chinese artifacts that were taken illegally. And so that could be an issue that is raised by the Chinese side when Mr. Cleverly is here in Beijing.
John, overall, I know that there's been a lot of concern about the strength of the Chinese economy. Do you feel it on the ground, or is it front page news?
It is definitely the thing that people are talking about. The mood here is very pessimistic, and that I think is primarily because of property prices. Home prices have continued to fall for a number of months, and with about 80% of household wealth tied up in people's homes, people, even if they're not making less, they're feeling a lot poorer as a result.
Thank you so much, Bloomberg Greater China Executive Editor John Liu there. Now joining us now to talk about the markets, the impact, of course, that the China slowdown or concerns about China has on the rest of the world is Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Karen, always great to speak to you, so thank you so much for coming on. When you look at some of the concerns on China, they seem to be getting worse instead of better. What does it mean for the impact that China has on Europe, for example?
Well, I think one of the reasons that Europe is looking particularly weak is because it is more dependent on China than the US, for example. So the question really is, what is China going to do to stabilize activity and try and boost growth? And I think this is the tricky thing at the policy making level, because traditionally that stimulus has always been build stuff, infrastructure, build new towns, build new infrastructure. But obviously they've had 2 decades of that type of stimulus. As John mentioned before, there is an overhang of property. So the question now is what type of stimulus? And we're seeing them over the past week, lots of tinkering around the edges, very much moving away from a build stuff model of stimulus towards an incentivize, more like what we do in the West, lower interest rates, try and incentivize people to feel better and to spend. But we know here in the West that that's less quick and it's less predictable. So I think how China plays out in the second half of the year is one of the big unknowns.
Karen, let's also listen to what Gina Raimondo was saying about this relationship between the US and China. Here she is.
We agreed to establish a new commercial issues working group, a formal working group, which will involve US and Chinese government officials, and very importantly, US and Chinese commercial private sector representatives, as we seek solutions on trade and investment issues and to advance US commercial interests in China.
I mean, it's difficult to see also in an election year in the US how the relationship between the US and China pans out and what that means for the rest of the world.
Yeah, absolutely. I mean, it's been something as investors we've had to contend with since Trump in 2017. And what we've learned, I think, through that period is there might be political ambitions that lead to things like tariffs and trade wars, but the economic realities of how far you can take these moves are limited just by how interconnected the economies are. I mean, we saw with the trade wars and the tariffs in 2017 and 2018, yes, it was damaging the Chinese economy, but it looked like it was damaging the US economy just as much. So I think trying to find that constructive dialogue approach through. But as you say, it's an election year, so I think we certainly have to be aware that there'll be some saber rattling along the way.
So what does that mean, Karen, for, again, things that you like at the moment? Is it equities versus, fixed income, or are we at the end of the cycle?
I certainly think we are still in an end cycle playbook. I mean, less about the relationship with China, but I think what happened in the first half of the year in the markets was a little too good to be true. Markets sort of bought into this idea that we could have resilient growth across the West, and yet all those inflationary pressures would disappear on their own, and the central banks could move from tightening to easing. That hasn't historically been the way things have played out, and I don't expect it to be this time around. Sadly, I think it is going to require that weakness. The likelihood of a recession, I think, is still high, because that's what's going to get rid of inflation.
What did you make of Jackson Hole? So it wasn't maybe the market-moving event that we've had in the past, but Jay Powell still was very, very clear in that rates could be higher for much longer.
Yeah, absolutely. I mean, the message from all of them in different ways was, we're not confident the job is done. We're not confident we are sustainably heading back towards 2%. Both sides very much worried about the inflationary pressures that are still emanating from the labour market, record low unemployment, and therefore wage growth staying high, and as Lagarde called it, that sort of tit-for-tat inflation. And I think that's exactly right. Until it's really clear that activity is loosening the labour market, that wage pressures are easing, we can't be convinced that we're back to 2. So that does leave us in a higher for longer world, which is really important for investors. And I still think that's where the investment community hasn't quite adjusted to this new world that we're in.
So, Kerry, if you think that actually markets were a little bit too optimistic in the first half of the year, are we going to see a correction in the second half, given also all these inflationary pressures, or the fact maybe that traders have not caught on that we could stay at these elevated interest rates for a lot longer than expected?
Yeah, absolutely. I think as we start to see, we saw with the PMIs, that was oh gosh, maybe the economic resilience isn't quite as we were hoping for, and it caused that reassessment of the realities. I do think we're going to see some more of that volatility. I don't think we're going to touch the lows that we saw last October. I think we are in a better place than where we were then, but I certainly think that more volatility, so staying very quality focused at these levels, starting to extend duration, that's the right thing to be doing right now.
I mean, the key to volatility is being able to call bottom. I mean, is that impossible to know when to enter the market?
Generally, I would say we should always be humble about our ability to do that. But I think right now, with how the world has changed, with some of the things we're just understanding about the energy markets right now, about the labor markets right now, there are so many structural shifts that are underway that I think that degree of humility, and certainly therefore about very outsized positions in either direction, that's not the thing to be doing right now. We've got a lot to learn.
Are markets not honed in enough on earnings fundamentals?
I'm not sure that's definitely the case. I mean, if you look at excluding, for example, the big tech companies, we can certainly see that valuations aren't obviously terribly excessive. Maybe a little so, given I do think we're going to see more earnings weakness than perhaps what's in analyst forecasts right now. I mean, one of the big questions, of course, out there is whether AI is this new economic miracle, or whether it's sort of the new economy that we heard Greenspan talking about in the late 90s all over again. But obviously for some stocks, I think certainly the growthy segments of the market, being really comfortable with your fundamentals, because as I said, I don't think zero interest rates, that zero discount rate, that's not going to come riding to the rescue as we look forward.
Karen, thank you so much. Karen Ward, of course, stays with us. We'll talk about the UK next as food inflation cools to its lowest level in almost a year. This is Bloomberg.
All eyes are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labor market is still tight.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, Friday on Bloomberg Television and Radio.
The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, the slowest increase in grocery bills in almost a year drove down inflation in British shops in August, relieving some of the pressures on the Bank of England to keep raising interest rates. Now, still with us, Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Karen, thank you so much for sticking around. When you look at the UK, for a long time we said, look, they have it worse than a lot of other countries. It's a small open economy with a tight labor market. Is this getting easier as the drop in inflation could actually come quicker?
Yeah, I mean, I think a few months ago, the UK really looked like the basket case, didn't it? The US inflation rate was moderating quickly. It was starting to happen in Europe as well, and just wasn't coming down in the UK. Now, some of that is lagged effects, which are going to come through. So I think the UK, on a relative basis, is going to look better. Energy is still contributing a lot. That's going to drop out. Food, as we heard this morning, that should start to drop out too. So headline's going to look better. Now, where the concerns still are there across the West, but probably more so here in the UK, are those deep pressures that we just talked about in the labour market, because our labour market is tight and our workers are asking for more pay. Understandably, they've had a huge shock to the cost of living. But that wage print that we just had recently shows, 7.8% wage growth is not consistent with a 2% unemployment target. 2% inflation target. So that's the challenge for the Bank of England now, is it has to create that weakness. We do need to see the labour market weaken. We need to see wage growth coming down for them to really feel comfortable that core is going to follow headline. So I don't think the Bank of England is as close to a pause as perhaps certainly the Fed and maybe the ECB are.
So what happens, I mean, is crunch time for inflation in the UK, but other places also when it touches 4%? Is there a worry that actually gets stuck at 4%? Like, what do the models tell you?
Somewhere between 4 and 3. I think that's right. I mean, we've seen as the US is sort of getting down towards 3, It's that 3 to 2 which is looking stickier. And of course, all the while you're stickier a little higher, you're at risk of something like an energy shock giving you another lift in headline inflation. I mean, that's one of the concerns I have about H2, keeping me a little cautious, is that oil prices, which are stubborn at 85, still a lot of uncertainty in the energy markets, how Europe goes through the winter. If we were to see headline inflation start accelerating again, when the labour markets are still tight and core inflation is still already high, we're going to be right back in those inflation, gosh, what are peak rates concerns. We've just got to be a little careful about that narrative.
Where do you think there are peak rates? And are we going to see cuts into next year, or will we have to wait for 2025?
I think we probably are near peak in the US. I think the Fed, we could get 25 basis point out of them at the next meeting, possibly also the ECB. I think we're going to probably get 2 more out of the Bank of England. I don't think as time passes, it's going to be quick enough for the labour market to weaken, for them to get the signals that they can pause. As to the cuts, I mean, this is where it's very tricky. Economies tend to be quite stubborn. I find myself in these days very much reminding myself of the 2000 cycle, where there was huge resilience as rates were going up, and it looked like the economies could cope with higher interest rates. But then, of course, when that crunch happened, it all unraveled quite quickly. I don't think it's going to be a 2008 style unraveling. The banking sector is in much better shape. We've already seen that this year. But certainly how things unravel, how sticky inflation is. But in direct answer to your question, I think it's going to be later. I don't think inflation is going to allow the central banks to ride to the rescue quickly at the first signs of growth weakening.
So, here, in terms of how you play the markets for the UK, does the UK look more attractive than it did even a quarter, or is it same?
No, I think, as I say, a few months ago, the UK was really seen as this outlier, this inflation basket case. Things were absolutely out of control. Maybe the Bank of England was going to have to see 6.5%. We were going to need this awful deep recession. I don't think that is the correct narrative. So I do think that, rates expectations are still pretty high, probably maybe a little high, but not too much. So I think re-entry into certainly the bond markets in the UK seems more sensible from here. I think that the stock market has been incredibly cheap on a relative basis for quite some time. I'm not sure what's going to bring sentiment back. I think it will be when we're well into the next cycle, we'll start to see some of that sentiment improve.
How tricky is all of this for the Bank of Japan?
Well,
I mean,
yeah, absolutely. I mean, we're going to see a convergence, that I'm confident of.
Yeah.
Now, the question is it going to be that everyone converges back down to the Bank of Japan? Yeah. Or is the Bank of Japan going to converge up to higher rates that we see elsewhere? I would say we're more likely to see the latter. I think the Bank of Japan has been saying, no, this is temporary, this is transitory, it's all going to go away. I've heard that narrative before. It didn't go away. And I do think, therefore, this adjustment that we're seeing to the policy, we're on a slow route of that continuing, and we'll continue to see yields push higher, and that's going to take the yen with it.
Karen, as always, thank you so much for joining us. Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Now, coming up, Goldman Sachs strikes a deal to sell an investment advisory business as it renews its focus on ultra-wealthy clients. Details ahead, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that Goldman Sachs' sale of its consumer lending unit Green Sky is entering the final stretch. And it comes as Goldman also plans to sell its $29 billion investment advisory business to Creative Planning. Bloomberg's Sue Keenan has a story.
This is a move that underscores Goldman Sachs is refocusing on what it does best, managing the money of the ultra-rich. The sale of the investment advisory unit is related to failed forays into consumer banking and efforts to market its services to the mass affluent class, the mere millionaires next door. Goldman has now agreed to sell the investment advisory business that grew out of its purchase of United Capital just 4 years ago. That unit has $29 billion, and Goldman not revealing the price, but says it expects to recognize a gain when the deal closes. Now, this is in stark contrast to the other sale Goldman is pursuing, the divestment of its consumer lender, Green Sky, at a steep discount, just over a year after it completed that takeover. Bloomberg has learned that the sale is now in the home stretch, with groups including Apollo and 6th Street working on what's poised to be their best offer. As for creative planning, the money management firm buying the investment advisory unit, it is run by Peter Mallouk, who's written several investment self-help books. His firm already has a custody deal with Goldman, and he said that expanding that partnership is a great strategic fit. Sue Keenan, Bloomberg, New York.
Well, the Federal Reserve's head of bank supervision in San Francisco will also retire on October 31st. Azhar Abazi, along with San Francisco Fed President Mary Daly, came under scrutiny in March following the sudden collapse of Silicon Valley Bank and other lenders. Abazi will be temporarily replaced by Neil Willardson, a former Minneapolis Fed official. Now, coming up, German consumer confidence drops more than expected this morning ahead of inflation prints tomorrow. Is Germany the sick man of Europe? We'll have plenty more on that next. And this is Bloomberg. Now, China's outlook shows no sign of improvement as economists trim their growth expectations while traders await a raft of data over the next few days. The UK's food inflation cools to its lowest level in almost a year, relieving some of the pressure on the Bank of England to keep raising rates. Plus, Bloomberg learns who the buyer is for Goldman Sachs' investment advisory business as the bank refocuses its attention on the ultra-wealthy. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Germany's GfK Consumer Confidence Index fell more than economists expected this morning. The September reading came in at minus 25.5 versus negative 24.5. Well, let's get more from our Bloomberg Europe correspondent, Maria Tadeo. Maria, good morning. So German consumer confidence or sentiment coming in worse than expected. We also get CPI flash, CPI prints tomorrow. Is Germany going to be the sick man of Europe for longer?
Yes, Francine, and that is a question at this point. And we know that they do not like this narrative. The German government has pushed back against the idea of Germany being the sick man of Europe. Last week also we spoke with the head of the central bank, Mr. Nagel, who also said that a lot of this was exaggerated. The problem is, Francine, when you look at the data, it does paint a bleak picture for the biggest economy in Europe. You talked about the consumer confidence that came in. It fell more than expected for September. It has been in decline now for months, too. When you look at the PMIs that we got last week, they were all bad, and not just the overall number, but really the three indices in sight not only point to a contraction, but they were also pointing to ongoing weakness in the manufacturing, and almost ruled out the idea that the consumer and services could be strong enough or gain enough momentum to balance out the weakness that we see play out in the industry. Now, that is for the consumer side of things, the confidence side of things. Tomorrow, we're expecting CPI coming out from Germany, and then, of course, the big number on Thursday, that is CPI for the euro area. This will be the final print, CPI print, before the ECB meets, with that hold or hike now openly on the table. Now, we are expecting both the headline number and the core number to cool down. But again, a lot of this will possibly make a difference to the European Central Bank when it comes to their assessment. But also, it'll be interesting to see how that feeds and matches the new forecast that will come up by the ECB in September, when that decision is expected to take place.
And of course, as even if we could see interest rates peaking in Europe, the pain for consumer companies and governments that borrow trillions of euros may not be over. Then, Maria, I know you and I are both obsessed with what's happening in Spain and in the football world. What's the latest?
Well, Francine, the controversy obviously continues. It has been going on for days. We all remember that World Cup win for the Spanish team and that kiss between the head of the federation and one of the players. And Francine, this is almost a gift that keeps on giving now. We have a federation that has decided to ask for the resignation of the boss, a suspension by FIFA, now potentially a legal battle whether or not there was consent in that kiss. The win has been eclipsed now by this moment, and now almost a bizarre hard turn in the saga, which not only involves Mr. Rubiales, he is the head of the federation, but actually his mom too, who it appears, as far as we know, that she's still locked up in this church on this hunger strike. And now what she says is that she's doing this in protest to what she believes are, quote, fake allegations about his son. The problem, of course, is that we all saw the moment play out on tape, and that kiss, whether or not it was consensual, that would play into what is presumed now will be a legal battle between both the federation, the now suspended head of the federation, and the player. Now, it's also worth stressing and pointing out that the Spanish government has interfered now in the situation, saying that he's no longer in a condition to lead the team, and there's also real pressure on the coach too for other issues that played out in the past. So again, it's a sad situation, almost bizarre too, and also it's a shame that the entire win has now been eclipsed by this incident.
Yeah, I have to say it is bizarre, but also very sad. Thank you so much for a terrific briefing, not only on inflation and some of the concerns on Europe, but also European football. Our Europe correspondent, Maria Tadeo. Now let's discuss the broader outlook for Europe and the global economy with Andrew Bell, Chief Executive, Witan Investment Trust, along with Bloomberg's Sofia Horta Acosta. Thank you both for joining us. I will not ask you about the football, although I'm very tempted to. When you look at the concern in Europe, rates could be in their peak, but when you look at a lot of the companies that have borrowed, I mean, we could be just at the beginning of, if not a recession, defaults, companies not being able to pay back what they've borrowed. Are you worried that it could turn all of a sudden?
Not massively worried. I mean, the surprise in the last 6 or 9 months has been how the US has not just not had a recession, but is actually booming at the moment, because they had a sort of rolling recession, and the bits that first went in are now coming out. And now I think the world's having a rolling recession, that the US is booming, probably set to slow down. China and Europe have hit the bumpers. The UK is kind of bumbling along in the middle. I don't think we're actually facing a major default crisis, but I think things are, people have underestimated after a decade when money was basically free, companies could borrow for 2 or 3%. Now they're having to pay 6 or 8%. That's going to put strains on, and some of these zombie companies that have kept going for the last decade probably going to go bust.
But so are you saying that it's companies that maybe don't deserve to stay on much longer that would be wiped out? And is that, do we underestimate the fact that if a central bank is going to bring inflation down from 9% to the target of 2%, then they will have to break things?
They don't have to do it in a year. I think one of the themes we've had in the last, actually since the beginning of the year, was that the peak in interest rates was going to be much more like Table Mountain, a plateau, than the Matterhorn. And I think once central banks have got confidence that inflation, having peaked, is now converging towards their targets, I think they'll be patient in the pace at which. So the Fed doesn't need to jack rates up to 7% in order to get inflation to 2% in a year's time. Ditto in Europe. I think there's more of a mindset in Europe that is disinflationary, because the ethos of the ECB is much more of the Bundesbank rather than the garlic belt. But so I think that something has to break. Yeah. Confidence has to break, but I don't think that the economy has to. I think, I mean, the central banks misread the surge in inflation, and they would lose more credibility if they crunched the economy and then had to be cutting hand over fist in a year's time.
Sofia, what does this all mean? So, I mean, if you see the interest rate differential between the UK and Europe or the ECB, we always thought that the UK was in a much worse position. But then we have some pretty encouraging figures today, especially for food inflation.
I mean, it is encouraging. I think that's an important story, because it's not just where the level of inflation is, but also the direction and whether it's telling us a trend yet. I think that the market is trying to convince itself that actually the worst of the fight against inflation here in the UK is over. Maybe we could no longer need that jumbo hike at the BOE September meeting, but inflation is still very high. There is a much tougher battle here. Even though food inflation, grocery shop price inflation fell below 7%. I mean, sorry, that's not groceries, that's the overall. But grocery shop inflation is still double digits. I mean, that's still incredibly high. The overall economy prices are still climbing a lot faster than the 2% target for the BOE. So there's still a lot of work to be done. And contrary to the US economy, like Andrew was just talking about, the UK economy is a little bit more fragile, significantly more fragile. So whether things break or not here, I think the line between the two, it's a finer balance for the Bank of England.
Yeah, and the labour market, without a doubt, is more tight here. than elsewhere.
Yeah, it's very tight, but also only about a third, people estimate only about a third of the increase in interest rates has fed through to the housing market because people are on 2 to 5 year fixes, and if you were on a fix 2 years ago, which was 1.5% for 5 years, when you come off it, it's going to be 6 or 7, and that's going to be so I think the Bank of England is cognizant of that. They will almost certainly tighten by another quarter, maybe a half, but I suspect that the economy is going to start showing the pain on the consumer side, within the next few months, and that'll take the pressure off the Bank of England. And I think they will be patient. If it takes 2 to 3 years to get from 7 to 2, but you've got credibility in the direction of travel, then that's okay.
Is there a concern that actually a lot of traders haven't quite, I guess, priced in the fact that we could stay at these levels for much longer than expected? Markets have had a tendency to price cuts either here in the UK or in the US, and they may not come.
I like that Andrew's saying we need to be patient and central banks will be patient, but markets are definitely not patient. I mean, July was all about soft landing. Because of the data that we saw there, wage growth was strong and inflation was coming down. Then August was all about higher for longer. What will September be? I think markets tend to kind of look ahead and they want to focus on the bright picture. And Andrew and I were just talking before coming on the set today that what will the brighter picture be? Will markets be focusing on the economy, i.e. we will get growth, we're not going to get a hard landing, there's no recession in the US and we'll all be fine, we'll muddle through? Or will they actually focus on interest rates and look at that instead? So I think markets kind of need to decide. There was definitely a read from Jay Powell's speech at Jackson Hole that was a bit more hawkish, but markets were okay with that. And we saw the huge, very, very solid auctions in the US Treasury market yesterday, huge demand for that. So will markets be okay with higher for longer? I think will be the September question.
Yes, September is on Friday. We'll be back with Andrew and Sophia. Andrew Bell of Witan Investment Trust and Bloomberg Sophia Ortega-Costa. Both stay with us for a conversation also about China's economic slowdown. We'll have a full roundup of what we heard at Jackson Hole. Coming up, also, Chevron workers at its Australian natural gas export plants are threatening to go on strike. More on what that could mean for the global energy markets just ahead. This is Bloomberg. More on the global economy with a special focus on China. Still with us, Andrew Bell, Chief Executive of Witan Investment Trust, along with Bloomberg Sophia Ortega-Costa. Witan, I've been mispronouncing it, but this is a council of wise men.
Yes, it was sort of Anglo-Saxon term for the local council, if you like. And it was all men then, but now nearly half our board are ladies.
I wonder what the wise men and women make of Country Garden. It's not looking good, Sophia.
It's not looking good. So this is China's biggest developer, or used to be at its peak, biggest property developer by sales. So this is no Evergrande. It's a well-run company. It was rated investment grade. I think it fell into junk territory in June last year. So how quickly it has fallen. Trying to delay its yuan bond payment. So this is due September 4th on Monday. And essentially what this says is that the Country Garden, the company is in a cash flow problem. It's not a debt problem like Evergrande, a cash flow problem because it's not selling properties. And we know this is a macro story for China, one of the most important macro stories. The property market is in a downturn and policymakers haven't been able to put a floor on that. So essentially it's saying we're trying to avert a default in the onshore market because that would really rattle sentiment.
And given all the concerns actually in China, you're still quite, if not bullish, you're less downbeat on China than most.
Yes, I think we've moved, for the last 2 or 3 months, it's been they're trying to do too little, too late. And I think we're just getting to a point where they're clearly announcing measures almost every weekend. And I think they will keep on doing that until it works. So we'll get a tipping point. And I think the Chinese government will do what it takes to get the consumer confidence back up and to enable these property companies to refinance themselves or for the debt of the companies to be taken onto the national exchequer. So I think they'll come through okay.
All right. Thank you both. Andrew, we have this great story about Citadel also vetting 69,000 intern applicants. Like, how many applicants do you get at
Not very many. We only have 6 employees because everything we do is outsourced. So
I was still expecting thousands of interns.
and they're looking for mathematical geniuses, aren't they? And mind you, they can lose money too.
They can, but we now have AI. Andrew Bell, Chief Executive Officer of Witan Investment Trust, and Bloomberg Sofia Orta Icosta. Now, possible strike action is threatening more volatility in natural gas markets. Chevron workers at its Gorgon and Wheatstone LNG export plants in Australia are planning work stoppages next week. Well, Bloomberg's Will Kennedy, who oversees all of our commodities team, joins us. Well, Woodside workers able to reach a deal last week. What are the chances that Chevron can do the same?
So this latest vote was a little bit of a surprise, Francine, given, as you say, that Woodside had done a deal. I think the expectation in the market had been that the Chevron workforce would do the same thing, and that hasn't happened as we saw in this vote. However, it doesn't ensure that there's going to be a strike. There are several stages that need to go through before they would walk off the job. But we have seen in gas trading today that it's gone higher again, and so there is some renewed nervousness about the potential impact of industrial action in what's been a very volatile market in the last few weeks.
So, well, what's the likely impact on global gas markets?
Well, Europe is in good condition going into the winter. Gas storage is more than 90% full, way ahead of where you'd see it normally, and it will reach 100% very early on in the season. So there is some confidence, but at root, without Russian supplies, Europe remains very vulnerable to any small changes in the global gas balance, and that's why their traders are so nervous about events in Australia, because although it's couldn't be further from Europe, it's a key supplier of liquefied natural gas, and any curtailment in supply there will have a impact into the broader market and could, especially if we get cold weather this winter, make conditions quite tight for European buyers.
Thank you so much, Will Kennedy there, who oversees all of our, of course, commodities coverage for Bloomberg. Now, coming up, drivers beware. The ultra-low emission zone is expanding in London. We'll discuss the political implications next. This is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, Telecom Italia is gaining this morning. That's after Italy approved a decree which empowers it to take a stake in its network business. The move is actually part of an effort by the Prime Minister, Giorgia Meloni's increasingly activist government, to assert more control over strategic assets. Now, for more on this, we're joined by Bloomberg's Milan Bureau Chief, Tommaso Ebhardt. Tommaso, good morning. So why is Meloni doing this?
Ciao Francine, buongiorno. It's quite interesting. The first act that Meloni did when she came back from her holidays in Apulia last night was approving a decree which allowed Italy to buy 20% stake, that means about 2.5 billion euros, in the new network unit by Telecom Italia. It's quite surprising that at the end of this long saga we see the government itself buying a stake in the former monopolies. It's showing, first of all, the strategic importance for the government of the network, and secondly, it shows the activism that Meloni is having the last few weeks in the Italian economy and the Italian business world. Investors are starting to get a little bit worried by this activism by the Italian premier.
So Giorgia Meloni is becoming increasingly active in Italian businesses. What's next, and are investors nervous?
Investors are getting nervous. We saw an unexpected windfall tax on banks, which was announced at the beginning of August in the last cabinet meeting before the summer break. Then we have Meloni now working on a new measure for non-performing loans. We have investors extremely worried because this new measure could jeopardize the non-performing loan market. We have Meloni investing directly in Telecom Italia. Clearly, after about 10 months when Meloni was essentially managing the show of Italian politics without too much noise, she is now showing that she really has the power and she wants to leave a mark. Is this going to be welcomed by investors? There are some question marks about it.
Thank you so much. Our Milan Bureau Chief Tommaso Ebhardt with the very latest on Italy. Now, London's enlarged ultra-low emission zone, or ULEZ, comes into force today. High-polluting vehicles pay £12.50 per day to enter the expanded zone. That's on top of the congestion charge for inner London. Here with the details, our Bloomberg Green editor, Siobhan Wagner. Siobhan, thank you so much for joining us. This is huge. It's a big deal, and the map is getting bigger and bigger. Other European cities are also following suit. So what are the arguments on both sides of the aisle?
Yeah, well, it's interesting. And what we've kind of pointed out in our story today is that, the mayor is kind of getting it from both sides. Some people that think he's gone too far, some people who think he hasn't gone far enough. On the too far side, this pollution charge zone now is extended into the outer boroughs where people are more car reliant and statistically lower income compared to central London. So to kind of force people to maybe, change their car or pay a fine seems a bit harsh now, considering, we're in a cost of living crisis. On the other end of the scale, you look at kind of pollution in the city, and still, the WHO would say that we're not kind of at safe levels for nitrogen dioxide. And some people have said, ban all diesel cars. So either way, he's getting criticism. Yeah.
And I mean, this is a huge political, hot potato, and we've seen it play out in by-elections here in the UK.
Yeah, so that's right. So because this is extended now into the outer boroughs, and one outer borough, one area that was up for election in July, Uxbridge, the former seat held by former Prime Minister Boris Johnson, it was just narrowly lost by Labour, and they really thought they had a chance in that spot. So as a result of that, and it's really because it's kind of ULEZ controversy got politicized there, and the Labour leader Keir Starmer asked Khan to have some reflection on the moment and maybe think differently about pollution policies going forward.
Siobhan, overall, I mean, could this be a blueprint for other big cities, or there are countries that, again, are looking at London, looking at the political fallout, and then deciding whether they implement the same?
It's interesting. So the mayors that kind of have spoken up and said that they're looking at ULEZ, they haven't really kind of commented so much on the controversy. I think what everyone's doing now is they're really trying to look at the results. Like, does it work? Is it going to reduce pollution? And if so, maybe the politics should be aside. This is the way we need to go forward anyway. Cleaner cars, cleaner air, yeah.
Siobhan, thank you so much, as always, for some great reporting. You can also find that story on the Bloomberg terminal. We'll push it out on social media. Siobhan Wagner, they're some of, our team leader, actually, for green energy. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. London time in our half-an-hour special. Here's what else we're looking out for today. The UK Foreign Secretary, James Cleverly, will be in China for talks focusing on Russia's war in Ukraine. At 1 p.m., we get Mexico GDP figures. Bloomberg economists see activity rising 4.6% year-on-year in June, but a recession in the U.S. is a main risk to growth in the country. Then at 3 p.m., U.S. consumer confidence data is released. And before the U.S. market opens, we got Best Buy second quarter earnings, which along with consumer confidence data will give us a picture on the strength of the U.S. buyer. Let's also look at some of the other things that we're looking at. Again, if you look at the U.S. two-year yield, probably the most important, chart that you'll see today. Hawkish more or less holding following the Jackson Hole two-year just below 5%. Higher for longer is coming to mind. We heard from Jay Powell. He spoke in a highly anticipated speech at Jackson Hole on Friday. He said that the U.S. central bank is prepared to raise interest rates further if needed, and that borrowing costs would likely remain elevated. That's going to hit yen. That's certainly according to Goldman Sachs. So let's also look at yen. The country with a very dovish central bank will see further currency weakness. And we heard it actually from Karen Ward of JP Morgan saying unclear whether central banks readjust to the Bank of Japan or whether the Bank of Japan readjust to other central banks. Up next, Bloomberg Surveillance Early Edition with Simone Foxman in New York and Danny Berger here in London. And this is Bloomberg.